This is the greatest trader of all time. His name is Jesse Livermore. He shorted the stock market right before the Great Depression and earned $100 million in the process. Yet, despite being such a talented trader and amassing such huge wealth, Livermore actually went bankrupt 3 different times. And when he committed suicide in November 1940, he had $84,000 in assets and $2.5 million in debts. Livermore was constantly living on the knife's edge of extreme wealth and extreme poverty. And the reason is because of leverage. Over the last couple of decades, the proliferation of ETFs has led to all kinds of different innovations, one of them being leveraged ETFs. If the stock market generates 10% per year and you were able to leverage that by 3 times, that would mean your long-term annual returns are 30% per year. That's what makes leveraged ETFs so tantalizing for so many people. But are leveraged ETFs a good idea for you to have in your portfolio? In this video, I'm going to try to present a balanced argument for the pros of investing in leveraged ETFs and the very real cons. TQQQ was created in 2011. That has marked the extremely impressive returns of the underlying NASDAQ 100, which turned a $10,000 investment back in 2011 into a $100,000 balance today. That's an 18.2% compound annual growth rate, but that's nothing compared to TQQQ. The triple leverage ETF has turned a $10,000 investment into nearly $1 million. That works out to a 38.8% annualized return. Seeing these returns, it is obvious why so many people are flocking to invest in these ETFs. It seems like an easy path to riches, and it has been for the last 15 years or so. However, there are several things that you need to know before you invest in this ETF, and especially if you're someone who is seriously considering putting a substantial amount of money in these ETFs, you need to think very carefully about that. Just know this is a highly speculative ETF investment, and it can go bad in a hurry. And that starts with the daily compounding. So if we look into the numbers here, the underlying index, the NASDAQ 100, generated 18.2%. If we take that and multiply it by 3%, that works out to 54.5% per year. However, what you'll notice is that the triple leverage ETF only generated 38.8% a year. Obviously, that's still outstanding, and you're going to take that any day of the week. If we could guarantee that these results would be repeated over the next decade, definitely this will be a fantastic investment. However, it's important to note that the triple leverage only applies to daily results. So as you compound that over time, it results in a lower long-term return, which is why we're seeing roughly double the long-term returns instead of the promised 3x, like the name implies. ProShares clearly discloses this on their website. It says the ProShares ETF seeks daily investment returns that correspond before fees and expenses to 3 times the daily performance of its underlying benchmark. For any holding period other than 1 day, your return may be higher or lower than the daily target. These differences may be significant. To illustrate why this is, let's say we have 2 hypothetical investments. One of them goes up 12% on 1 day, and then the next day it goes down 10%, and it repeats this pattern for a total of 30 days. The other investment is a triple leverage version of the first investment, so it goes up by 36% on the up days and down 30% on the down days. So if this hypothetical investment would grow at that rate, your $100,000 investment in the non-leveraged strategy would grow to roughly $110,000. So if you assume that the leveraged version of this should generate 3 times that, or $130,000, you would be wrong. The leveraged version actually shrinks a $100,000 investment to under $50,000. So while the non-leveraged position went up 10%, the leveraged position actually declined by 50%. Now, obviously, this is an extreme example, but it illustrates the destructive power that volatility has on long-term returns. And as you hold this for longer, things get even worse, particularly if you have a bunch of bad years grouped together. But we can't know that without going back further in history, and we can't go back further in history because the ETFs did not exist going back before 2011. So I built a Python script that takes daily NASDAQ 100 returns and triple leverages them. And then it calculates how an investment like that would have grown over time. My simulation did not consider any fees or other expenses. It just simply took the triple leverage return on each day and compounded that over time in the NASDAQ 100. So this is a $100,000 investment made in 1985, which is when the NASDAQ was first initiated. The red line represents the triple leveraged portfolio, and the blue line represents the non-leveraged portfolio. And you can see that over this entire period, the triple leveraged portfolio did outperform the non-leveraged portfolio. However, the long-term returns were less than half that the triple leveraged seems to imply. So instead of getting 3 times the long-term return, the investor in the NASDAQ only got 1.46 times the return. And if you consider that this ETF has roughly an 80 basis point fee, that drops even further to 1.4 times. And then if we have any other leverage or slippage costs from bid-ask spreads or any kind of error on the ETF's front, that could drop even further. But the biggest risk with this ETF is the risk of ruin. The maximum drawdown for this portfolio was negative 99.96%. Essentially, this portfolio for a long-term investor was entirely wiped out. This chart shows the maximum drawdown for the non-leveraged index, which is here in the blue line. The red line is the triple leveraged drawdown. And you can see that the 99.96% drawdown was essentially enough to entirely wipe you out, and anything multiplied by 0 is basically 0. So if you had purchased this ETF at the all-time high and held it for 25 years, you would still be down more than 65% top to bottom, despite the NASDAQ's extraordinary run from 2011 all the way to 2025. So when you look at TQQQ today, you're really looking at this period right here, where the NASDAQ basically did nothing but go straight up. Therefore, the triple leverage portfolio also did nothing but go straight up. However, if you get in a situation where technology stocks are in a bubble or you have a significant drawdown, it is very possible that this triple leveraged ETF could wipe you out entirely. And that's what you see whenever you study all the great investors of the past. They all advise against using leverage. Why? Because $10 billion or any number multiplied by 0 is still 0. Warren Buffett talks about the things that snap you in life, and he says the 2 biggest weak links for people's lives in his experience, he's seen more people fail because of liquor and leverage being borrowed money. George Soros says using leverage can produce superior results when the going is good, like it's been with the NASDAQ generating 18% annually since 2011, but it can wipe you out, meaning multiply by 0 when events fail to conform to your expectations. Guy Spear says for an individual investor, debt or leverage can be disastrous, making it even harder to stay in the game, both financially and emotionally, when the market turns against you. So, should you buy leveraged ETFs? I'll just say for myself, I do not own any leveraged ETFs, nor do I have any plans to ever own any leveraged ETFs. I think the risks of ruin just simply outweigh the potential benefits. Now, if you're someone that says, you know what, I have some money that I can afford to lose, by all means, if you want to speculate on a position, see how it goes, do whatever you want, but just don't invest any money into a leveraged ETF without you planning on that money essentially being gone. At the end of the day, I think the leveraged ETFs, particularly TQQQ, represents an extremely fun way to go broke. And that's why I've named it the title of this video. I think that sums it up about as well as anything could. On this channel, I do my best to provide high quality, data-driven investment education. For exclusive member-only videos and to support my channel, you can join as a supporter for $4.99 a month. And if you want even more content, you can get access to 2 of my e-courses and all future e-courses that I create for just $20. That gets you access to nearly $400 worth of my premium e-courses. The How to Value Stocks e-course looks at how famous investors like Warren Buffett, Peter Lynch, Benjamin Graham, and more, the methods they use to value stocks. There are 52 videos and over 4 hours worth of content. And if you're a beginner or intermediate investor, you should check out the Financial Freedom Formula course. And this course will basically take you from absolute beginner to understanding how much you need to retire early. We'll talk about tax saving tips, different asset allocation models. This course is jam-packed. I've had a lot of really good feedback on this. The first 10 videos are available to everyone, so if you want to check out what the course is like, you can check out those first 10 videos. I'll put a link in the description down below to that course playlist. You can also access similar content on Patreon if that's your preferred method. I'll link this in the description below as well.